You ever look at your bank balance and feel like money is sneaking out of your account while you sleep? That was me, until one audit found $7,963 sitting in plain sight. 9 months of tiny decisions, one stubborn spreadsheet, and a handful of phone calls turned into a $7,963 boost that I'm using as the exact rocket fuel for my 2026 budget plan. If you do this audit before 2025 ends, you'll be starting 2026 with momentum, not regret. Stick with me. I'll show you where the leaks were, the weird habits I had to stop, and one single investment fee change that surprised me the most. This audit mattered more than a monthly budget, and it rewired the way I think about money. I'm going to pull back the curtain and show you exactly where that $7,963 came from, down to the dollar, and the steps I took to recover it. More importantly, I'll explain how recovering this money right now will give my 2026 budget plan an immediate, powerful boost. If you want a zero debt, zero regret 2026, you absolutely must do this audit before 2025 ends. Let's dive into the masterclass. The first leak was the easiest, lowest effort win, and it immediately motivated me to continue the audit. I looked at my bank statement and saw dozens of recurring charges for streaming services, specialized fitness apps, and forgotten memberships. I was guilty of paying for potential future use, not current utility. I saw microcharges I'd forgotten about, tiny fees, and old subscriptions bleeding cash. My other ghost fee was my own bank. I reviewed my banking account and realized I was being charged tiny recurring fees that added up. By switching to a no-fee account or meeting a minimum balance requirement, I eliminated those charges. Here was my action plan. The 90-day rule: if I hadn't actively used a service in the past 90 days, it was instantly canceled. I stopped paying for potential future use and only paid for current utility. By applying this discipline and eliminating unused services and fees, I conservatively cut $75 per month in bloated entertainment and unused services. $75 per month for 12 months meant nearly $900 annual savings. Banking charges saved were nearly $180. That $1,080 felt good, but it was just the start. This immediate, easy win provided the psychological momentum necessary to tackle the next, far more painful leak, the one tied directly to my personal habits and regrets. If you like this type of content, drop a like and subscribe to join our community. It helps the channel to grow. I discovered that my second largest financial drain was a combination of mindless dining out and impulsive online shopping. I realized overspending on entertainment, like dining out, was one of the top financial regrets for people like me. This is the impulse trap. I found that I was one of the 52% of millennials who were more likely to be a spontaneous shopper. I was shocked when I realized how quickly impulse purchases added up. My average spending was $281 per month on impulse buys. While I didn't cut all of it, I realized I could dramatically reduce it. The other component was dining out. Reducing the frequency of dining out by planning meals and cooking at home can result in substantial savings. My action plan: discipline and delay. The frugal switch: I focused heavily on reducing non-essential spending categories like entertainment and dining out. By cutting dining out from 3 times a week to 1, I forced myself to learn how to cook and meal prep. The 48-hour rule: to combat the addictive nature of impulse buys, I implemented a strict, non-negotiable behavioral guardrail. For any non-essential purchase over $50, I had to wait 48 hours. This simple delay gave my rational brain time to override the emotional desire for instant gratification. By aggressively reducing impulse purchases and limiting dining out, cutting roughly $150 in impulse and $180 in dining out over a month, I conservatively freed up $200 per month in my budget. $200 per month for 12 months meant $2,400 annual savings. I used to think my fixed costs, insurance, phone, and internet were immutable. I should have realized a long time ago that every bill is negotiable. I performed a concentrated effort to call and review 3 major services. Phone and internet negotiation. Big providers often hike prices without asking. I called both my phone and internet providers and asked for loyalty discounts or threatened to leave. Experts say one focused 20-minute phone call session can easily save you $200 to $500 annually across multiple services. I managed to secure a $20 per month discount on my internet and a $26 per month saving on my phone plan by switching to a more affordable carrier. Insurance optimization. I reviewed my car insurance coverage. I realized I could potentially save money on premiums by opting for a higher deductible, as long as I could comfortably pay the higher out-of-pocket cost if I filed a claim. The average savings from raising a deductible by $1,000 is about $278 a year. I took this saving and banked it, ensuring I had enough to cover the higher deductible if an emergency arose. Even combining policies also helped. By combining the bill negotiations and the insurance optimization, I achieved a solid, predictable saving of $840 for the year. This leak was by far the most destructive, silent killer and the second largest contributor to my $7,963 haul. It was high-interest credit card debt. I'd been making minimum payments on a recurring balance, and while I thought I was managing my debt, I was only serving the bank's bottom line. The minimum payment trap. Millennials carry significant debt with average credit card balances hovering near $7,000. The average APR on new card offers is alarmingly high, around 24%. I had a $5,000 balance at a high APR. I realized that paying only the minimum amount often covers only a small portion of the principal, leading to more interest accrual over time and trapping me in a cycle of debt. If I had continued to only make minimum payments on that $5,000 balance at a typical 22% APR, it would cost me an agonizing $7,703 in interest over the lifetime of the loan. I should have paid more a long time ago. Only making the minimum payments results in a prolonged repayment process. It could take more than 11 years to pay off a significant balance at average rates. The biggest breakthrough in my audit was recognizing that the $4,140 I recovered from leaks 1, 2, and 3 was not spending money, it was ammunition. I immediately funneled some part of that directly into the principal balance of my highest interest credit card debt, exceeding the minimum payment. Any bonus I got went into reducing the high interest rate debt first. By accelerating the payoff and making larger payments, I short-circuited the debt cycle. I was able to save $2,023 by making aggressive payments. This is financial freedom achieved through simple discipline. Before we move to the last 2 leaks I plugged, please smash that like button and subscribe to help me reach more such like-minded people. I used to assume mutual funds were fine because they're managed, but management costs money, and that fee is quietly a recurring tax on your returns. If a mutual fund hasn't beaten a broad market index for 5 straight years, that's a red flag. For me, the math was simple and brutal. I moved a chunk of my taxable and retirement balance from an actively managed fund, charging approximately 1.2% expense ratio, to a simple broad market index fund charging approximately 0.06%. On a $120,000 portion of my portfolio, that change immediately lowered annual fees by about 1.14%, which equals $1,368 per year. Over just a few years, that compounds to serious money. That $1,368 figure is in our final tally, and it's the reason this audit isn't just about cutting pizzas and coffee. Sometimes the biggest wins are fees you never see. The last part was the hard one, where I didn't want to compromise my lifestyle yet pull something so that it feels I'm not wasting. I switched to a cheaper phone plan and some change savings which were lying around. I started gathering them dollar by dollar. I started becoming mindful of the energy bills and started using Energy Star certified equipments more. This way I pulled up another $252 more annually. Here is the complete breakdown. The total came around $7,963. That was the money I could have saved long back or invested in something meaningful. This audit forced me to prioritize. I didn't ban fun, I reallocated it. I kept what mattered, one streaming service, weekend dinners only, and removed what didn't. That cluster of small decisions created space for bigger goals, paying down debt, building an emergency cushion, and investing more efficiently. I will now start 2026 with a $7,963 head start. Money that I would have otherwise thrown away. That's not fantasy. That's the result of a single, focused audit. If you do one thing after watching this video, pull 3 months of statements, highlight recurring charges, and cancel 3 things. Then call one provider and ask for a lower rate. Those 7 minutes of work will compound into real dollars, real peace of mind, and a real boost into your 2026 plan.